So I want to do a brief introduction. My name is Tomas Campos. I'm the CEO of Spinwheel, and I'm really excited to dive into such an enormous opportunity for 401k and financial benefit providers, and the potential impact it has for the American employee. What we're going to talk about today is a topic that I'm very passionate about, and I think there's never been a better time for providers and employers to improve the financial wellness and outcomes of their employees and their participants. The mission that we have here at Spinwheel is to really improve the financial outcomes of Americans in debt. And I'm convinced that the role that 401k providers and financial benefits providers can be one of the largest, if not the largest, role in that mission, especially given the situational landscape we have today. So that said, why don't we go ahead and dive in? And I think the best place to start is to really dive into student debt and talk about that a little bit. I know this is something that has been out in the media and out there for a while, but I think understanding the complexities and the nuances of student debt is important to understand how you can then set up the best program and take advantage of this opportunity. So the thing that really stands out to me, and I think is important for programs, is that student loans and student debt is the most unique and complicated consumer debt in the United States today. We'll talk about this more, but the average borrower has anywhere between 4 to 10 loans at a servicer, each with their own interest rate, repayment plan, and terms. And that is unique. That is not structured like any other consumer debt or any other consumer loan in the United States today. And it creates its own challenges and opportunities. The second is that this is usually the first and largest liability and debt that Americans take on in their lives. And it sets the tone for the way that they can actually proceed through their financial lives for the next 20 to 30 years. Student loan debt is also unique in the sense that it is effectively impossible to discharge during bankruptcy. Most other loans, if you declare bankruptcy or you enter bankruptcy, you can get them discharged, but student loans are treated in a very unique way because they're held by the federal government. The other thing is that because of the very nature of this program, it really receives some of the most attention from government, media, and politics. When most people cite the number of borrowers impacted by student debt, it's north of 43 million Americans that have student debt. But the more interesting figure for me is that it's actually half of all of the American households that are impacted by student debt. So when you think about those dynamics of student debt, and as we get into some of the programs we're going to talk about today, it's important to understand how your programs and how your participation in these can take advantage of those. The other thing that I think is important is why now? Why are we talking about this now? Student loans is not a new thing. It's been a crisis for a while. Why is it important? And why is this an opportunity that is uniquely timed for this moment? The reason is that the landscape is changing faster than it ever has before. And I think there's really two key elements here. One is if you look at the student loan landscape itself, and then the other is just the overall economic and legislative landscape. So starting with the student loan landscape, the things that are important to call out is that we've been in a moratorium for 3 years, and that moratorium is ending, which means that 43 million borrowers are going to have to go into repayment anywhere from 2 weeks or 6 months from now. The other thing that's happening here is that there's been an overhaul of the student loan servicers during the same time period. So nearly half of borrowers are getting new servicers or have received new servicers. And that's important. So when you think about how you can set up your plans and the implications that it has very important nuances on how you can set up your plan, especially in this landscape of servicers that are changing and what that means for participants. The other thing that's happening is the government continues to overhaul and launch new repayment plans. Now, repayment plans are important because depending on what type of repayment plan you're on, has different treatment for some of these programs. So as these plans are being refreshed, some are being sunsetted, some new ones are coming to the picture. Understanding how borrowers are participating in those plans, what plans they're on, are an important aspect to any program. The other part that I don't think is talked about enough, but is pretty profound in terms of what it means for borrowers in the programs that are being designed, is the fact that every borrower that's part of a federal student loan program, which is 93% of all borrowers and 92% of all borrowers, are going to have to re-enroll in auto debit. The reason why that is significant is not just because that's an additional administrative step that a borrower has to take, but it's because it represents a 25 basis point reduction in interest rate. So said otherwise, if you are enrolled in an auto debit with your servicer, you will receive a 25 basis point reduction in interest rate. The converse of that is if you don't enroll or you don't re-enroll now as part of that, you're not going to be paying 25 basis points more than you would before. And that's really, really important for borrowers. And what we found through our own research in engaging with our borrowers and our users is that 60%, nearly 70% of them did not even know that they're going to have to re-enroll in auto debit to save this additional money. So there's a lot of things happening in the student loan space by itself. And when you couple that with some of the other changes that are happening both on the legislative and the economic factor, it really is creating a unique opportunity. So some of those things are, we've talked about, we're going to talk about some more in terms of the legislative factors, but with the CARES Act and the Secure 2.0, there really has been a very important shift in the stance of the government. They're really looking for employers to jump into the problem, help solve this problem that we have in the country right now. And we'll jump into those in more detail as to what they actually mean. But this is very unique in the sense that the government's really taking more action and is being more aggressive to try and create these incentives for employers to participate. The other thing is, if you just look at the economic factors that we're facing today, it's also extremely unique. In fact, it's unprecedented. So when you look at the fact that we are in one of the we have one of the lowest unemployment rates in the country right now, it really speaks to the fact that we're actually in one of the most competitive employment markets for employers today. I can't think of a more difficult time that it's been to actually recruit, retain, and engage your employees. And the low interest rate, the low unemployment rate just speaks to that. So this is a time where it's never been harder, in my opinion, to attract talent and to retain that talent. The other thing that you're seeing is that you have very, very high rates of inflation. So not only do all Americans get impacted by high inflation, but when you think about the fact that student loan borrowers today, already have, or even before the pandemic, before these high rates of inflation, were already struggling to make their payments. The fact that the cost of everything else in their lives is going up substantially, especially food and fuel, puts more pressure on them to be able to make their payments. And so when the average student loan payment is nearly $400 a month, the added inflation is making it harder for them to keep up with that. And like I said, more than half of borrowers said that it was going to be hard for them to make this $400 payment before we entered into this period of high inflation. That number is only certain to rise, and more people are feeling the pinch of this with that inflation. The last portion of the economic factors that's impacting this is the rising interest rates. And the reason why that's important is because for a select group of the population, being able to refinance your loans was an important escape valve or pressure release valve from the pressure of your student loan debt. But we just came from a period where we had historically low interest rates, and now we're getting into a period where we have historically or increasing interest rates. So a lot of people now are being priced out, or the interest rates are not going to make sense for them to actually able to refinance. And so those factors combined are making it more important or even more difficult for borrowers to actually deal with this. And it puts more of an incentive or more of an importance for employers to participate and help out. And that's really what this last point speaks to, is that the overwhelming majority of employees, nearly 78% of them, feel that their employer should be helping them with this situation. So when we dive into that a little bit more, study after study has come out that has shown that when employers do participate, when they actually do jump into this problem and help their employers out, it has profound impacts in terms of both retention, acquisition, and productivity. There's a great study by PricewaterhouseCoopers that found that productivity dropped substantially when people were stressed out over their finances, and specifically student loan finances, because of the impact that it has on their lives, especially in their earlier careers. But I think the other important part here that's extremely important is the impact that student loans have on participation and savings for retirement. So it's clear that 80% of people who have student loan debt have said that their student loan debt is dramatically hurting their ability to save for their retirement. But one of the things that I think is extremely important is when you dive into those numbers, it actually doesn't matter what income level you're at. So the Center for Retirement Research out of Boston College did a study and found that people who have student loan debt have less than 50% of the balances or the contributions that their peers have. And what was interesting about this study is it was irrespective of the amount of money they made. So even if you were making $200,000 a year, or you're making $50,000 a year, it didn't really matter, because in each of those different income levels, you were still saving less than 50%, or you were contributing less than 50% of your same peer that was doing it and had the same income level, but did not have student loan debt. So this is from our perspective. And when you look at why the government's trying to incentivize employers to take advantage of this, it's because it can have a real impact. And we see this firsthand in terms of the participation rates in 401k programs, the savings for retirements, and then the overall financial wellness of employees when it comes to student loan debt. So why is the government focusing on this, and what does this mean for providers and the plans? And really the two big pieces of legislation that we're going to talk about today is the CARES Act and the Secure 2.0 Act. So CARES Act, we don't have to dive into this too much. I think that the salient points here are that this was really enacted at the beginning of the pandemic, when the government was really worried. And I think we were all worried about the economic fallout of a global pandemic. And it's important to note that amidst that backdrop of fear for the economy, there was a big focus on student loan debt. And really what it did is suspended payments and collections for all federal student loans out there. It set interest rates at 0%. And the other aspect of the CARES Act is it actually almost doubled the tax-free treatment for contributions from employers. And that's important, and we'll get into that a little bit more. But effectively, that was what the government did as part of the CARES Act. Now, the CARES Act, or this payment moratorium, is expected to end. Now, technically, it's set to end at the end of this month on October 31st, meaning that without any other changes or any other extensions, all of these federal loan borrowers, who are nearly, like I said, 43 million or more borrowers, are going to have to go into repayment starting at September 1st. But we widely believe in the industry that it's going to be extended again. Just the proximity of having that type of impact on borrowers that close to a midterm election, when there's already a lot of talk about it and there's already a lot of focus on it. And generally the fact that it takes some time for borrowers and servicers to be ready to enter into repayment, we widely believe that it's probably going to be pushed out to the end of the year. And if last year was any indication of what we'll see, it was set to January 31st. And so we really do believe that it'll be pushed out to January 31st, but we're ready, and we're advising all of our partners to be ready that it does actually go back in effect in 2 weeks from now. The other part here is that the tax incentives that came along with the CARES Act, they do not expire this year. They are set to be extended until 2025. And again, it's widely believed that these will be made likely permanent. The reason why we believe they'll be made permanent is, again, the federal government is really leaning on providers and employers to take up some of this problem and help as much as you can. And this is huge incentive. Now, when we talk about this incentive and the tax-free elements of this, there's really two aspects of this tax-free treatment. The first is for a contribution by an employer to a qualified student loan, the employer will not pay a payroll tax on that contribution. On the same token, for that same contribution that employer makes to a qualified student loan on behalf of their employee, the employee will not pay an income tax on that. And so the employee sees the benefit in terms of the tax and the contribution towards their student loan, and the employer sees the benefit because they don't pay the payroll tax on that. So this is a very unique program. One of the things to note here that we'll jump into a little bit more is, again, having to understand what's a qualified student loan and how that payment gets applied. The other portion of legislation that's in works right now is the Secure 2.0 Act. It's not law yet, but I think what's really important is that this is based on the IRS private ruling in 2018. And really what the private ruling said was that matching contributions from employers towards 401k programs for employees or participants can still be treated under the same tax advantage guidelines that normal contributions are made if that employee is making a contribution towards their student loan debt that's greater than or equal to 2% of their monthly income. Now, that precedent has already been set out there by the IRS. We believe that it's going to be codified in the latest legislation, but this latest legislation goes further than that. And when we think about this legislation, there's, again, two key parts to this that we feel are really important for plan providers as it relates to student loan debt. The first is that whether it's the version of Secure 2.0 that has passed the House already, or the two versions that are still in the Senate that is expected to be reconciled and signed into law at the end of the year, all of those versions of the bill have an automatic enrollment provision, which means that if you're an employee and your employer is offering a 401k program, you will automatically be enrolled into that program. When you couple that with the other aspect, another provision in Secure 2.0, which essentially says that contributions by the employer towards a 401k program that are based on a employee making at least 2% contribution or more towards their student loans can still be treated in the same way, is important. It puts additional requirements on plan providers and employers to manage those aspects of the program, both in terms of are payments being made adequately towards student loans, are employees actually enrolled, and can we essentially understand how much of those contributions are being made both towards student loans and to the 401k programs. So those two pieces of legislation are extremely important. And what I'd like to talk about now is some of the best practices we've seen from the partners that we work with today on how they're either setting up their programs for Secure 2.0 or how they have set up their programs to take advantage of the CARES Act. So one of the first pillars of success here is really around coverage and data. And what this really speaks to is in order to really take advantage of these programs or to design programs that comply with these, as we talked about, you have to understand, one, what type of loan the borrower has, what type of repayment plan they are on, and what are the payments that are making towards that. Those are all really important elements to make sure that your plan is compliant and that you can run your plan effectively. We've seen this in the past where if you are missing some of those, your program can really struggle, or you can fall out of compliance, or it can create a lot of issues for the participants. The other part that's really important is understanding the payments that are made. Now, if you don't understand how much of a payment or how much of contribution is actually being made either by the employee or the employer, again, it can be really, really difficult. The last part is just coverage. So if you don't have enough coverage and you're not able to understand the loan type or the repayment plan or the payment data or the payments that are being made for enough of the servicers, then you're going to be in a situation where you can't actually support enough of the participants in your program. So some of the best programs that we see out there today really have a fantastic coverage and have fantastic data that can really support their programs running very, very smoothly. The other element here is around what I would call essential capabilities. Now, these essential capabilities, they're different than the coverage and data, but they're very, very important when it comes to how your program and your plan is set up. The first is, I would say, around precision payments. As we talked about with student loans, you can have multiple loans at one servicer. The average borrower has anywhere between 4 to 10, each with their own interest rates, and each of those loans can have their own repayment plan. So being able to make sure that when you make a contribution, let's say on behalf of your employee, that contribution is going to the right loan at that servicer is important. It's not sufficient to just be able to send a check or to send money directly to the loan servicer and expect that loan servicer to know how to direct that payment to one of those 4 or 10 loans. Being able to make those payments directly to the loans with the specific repayment plan or loan type that you're looking for, or even more importantly, the ones that are going to have the highest impact for the borrowers, is critically important for these programs. The other thing that we think is really important and that we've seen as a best practice for our partners out there today is being able to communicate and represent the contributions and the impacts of these contributions. So, nothing is worse, in my opinion, than having a fantastic program for your participants, for your corporate clients, or even for employees, but then the employee not understanding what the impact of that benefit is. So when we look at some of the best programs, and one of the key pillars of success is being able to clearly communicate to that employee or that participant how much contribution has been made, what is the impact of that? And what I mean by the impact of that, it's really, hey, how much are you saving in terms of time and money? How much has been contributed from your employer? And even how much faster are you making progress towards your retirement goals? And those are all things that are really important for the employee to understand the benefit of the program and really gain all the benefits of that. The last one here to call out is that auto debit enrollment. As we talked about, if the employee or the participant is still paying 25 basis points more because they didn't know that they needed to auto enroll. And the answer is to just go send them off their own and hope they do that. That's not the best experience. Some of the best programs that we see is being able to have the ability to have a click of a button that will allow that participant to auto enroll into auto debit again and save that 25 basis point expense on a monthly basis. The last pillar of success is really around ongoing support and compliance. This is extremely important, in my opinion. What we've seen, as we talked about, is this huge shift with loan servicer migration that impacts nearly half of all borrowers, can really create a lot of problems for a program. And so if you do not have a provider that can provide the support, that seamless support for these loan servicer migrations, you can end up in a situation where a lot of your borrowers either get disconnected unintentionally or maybe have to re-enroll in the program again because their servicers have migrated. So being able to have that type of support. And the other aspect of this is just having that reliable connection, as we talked about. If you don't have a connection to the servicer for you able to validate the data, validate the plan that they're on, making sure that that loan is actually available for repayment, then you could be in a situation where your program is suffering because employees or participants are either getting kicked out or they're being asked to sort of reconnect or true up at the end of a cycle. So these are the things that we see in the space that are really, really important for the pillars of success of any program. To talk about some of the common pitfalls we see, which is sort of the inverse of this, one of the things that we see is just not being able to validate the account. So the reason why this can cause a lot of problems is if that either you don't have a provider or perhaps you're working with the technology provider that is not purpose-built to support these types of programs, you will be in a situation where you cannot actually understand the specific loan type, the repayment plan, the payment data for that loan. And the reason, again, why that's super important is if you're not able to validate those three things, you can't actually understand if that participant or that loan actually qualifies for the actual treatment or the benefits that we're talking about. The other example that we see here is oftentimes if you're not able to validate that account is still open for payment, the participant or the borrower or the employee might have refinanced their loans, or maybe they already paid off all their loans. And if that change occurred between when they enrolled in the program and now a contribution that's being made, you can run into a lot of problems. So this is a common pitfall that we see. This is oftentimes something we see for partners who've been using other technology providers that aren't purpose-built for this program. And this is something that we can absolutely help with. The second here is user being disconnected or removed. So this is a little bit of an extension of what I just talked about. But instead of this being something because the employee or the participant or the borrower changed plans, paid off their loan or refinanced, this is really an aspect of a technology provider that really can't maintain a stable connection. We've seen this firsthand in the market for a lot of the programs that we've worked with before we're coming in. Anywhere between 25 to 40% of all of their participants or all of their employees were in a disconnected state. What that means is that almost half of the participants needed to reconnect their loans, or when they were in that disconnected state, they really couldn't take advantage of the program. And it created a lot of problems and a lot of friction for these programs. So this is an extremely important one, is being able to go with a technology provider that can give you stable and consistent connections so that users don't get disconnected and effectively kicked out of the program, and then eventually leading to either true ups at the end of the year or potentially just very disappointed or disgruntled participants. The last one here is around applying payments correctly. There was a class action lawsuit by borrowers against loan servicers, because what's sort of a very little known fact is that when a payment is sent to a loan servicer, that loan servicer, without any other instruction, has the discretion to apply those payments to any one of those loans that we talked about underneath. If a payment is applied to a loan that either maybe doesn't qualify or perhaps gets applied to a loan that is not in the best interest of the borrower could actually receive less of that benefit or not actually get any of that benefit at all if the payment is not applied correctly. And so there's a lot of nuances on how you need to set up the way these payments get applied, and not having a technology provider that can actually do that can cause a lot of problems for your program. So these are common pitfalls that we see. And talking about Spinwheel, we're not going to spend a ton of time on this, but this is what we built our platform for. We are a purpose-built technology platform specifically focused on being able to provide all the capabilities that any provider would need to run a great program. Some of the things that we didn't talk about too much, but I think are important, are things like being able to have drag and drop tools. So creating those user experiences can sometimes be very, very time consuming. This is something we focused on. We were able to provide these tools that make it very easy for any provider or any program to be able to create these experiences. We're also fully SOC 1 and Type 2 compliant, and we have the most coverage in the space today. So this is something that we're very focused on, and we'd be very, very excited to work with any provider out there who really cares about this type of program. To that end, one of the case studies I'd love to highlight is our partnership with Betterment. When we think about programs that are designed correctly and have approached this space correctly, Betterment has done a fantastic job. They really have focused on not only designing the programs that make it very, very easy for all of their corporate customers to participate, but they've also focused primarily on the employee and how to make sure that they understand the benefit and the value that they're getting. And so if anybody wants to learn any more about some of our capabilities, any of the topics that we talked about today, or even this case study, happy to do so. You can always reach out to us on LinkedIn or spinwheel.com. We'll also be following up with an email after this for anybody who's interested. So with that, I think we have a couple minutes left to dive into some questions, and I see a few that have come in here. So let me see if I can get a couple minutes here. So first question that I see here is, what is the difference between the CARES Act and Secure 2.0? So CARES Act, as I covered, was a bill that was passed that really is focused on enhancing employer contributions directly towards student loan debt. It really doesn't talk at all about 401k programs or retirement. And it was also the one that set into effect the payment pause. Secure 2.0 is the bill that's making its way through Congress right now, expected to be passed at the end of the year here, that is really focused on driving increased participation in retirement programs. And a key provision of that is to allow matching contributions if an employee is making payments towards their student loan debt. So that's the difference between those two acts. The next question that I see here is, I've heard some programs are running their program by doing manual statement uploads. Yeah, okay. So this is one that we've also seen and that we also helped some of our partners with that were doing this way before. So what they're talking about is effectively asking an employee or a participant to upload their student loan statements every month or at the end of every year. And a key issue that we've seen with that is, one, there's a lot of friction. It's a lot of responsibility for an employee to manually upload this information every single month. Inevitably, they're going to forget to do it. And what ends up happening is if they don't do it, it can really throw your program off. If you're doing it at the end of the year, what ends up happening is now you have to do a true up across the entire year to be able to do that. And so the best programs that we see out there today avoid that headache altogether and really use a technology provider like Spinwheel that can make sure that behind the scenes, all with an API-based program, you can go get that information, pull it in, and be able to do this without having any manual uploads. The other question see here is really around, does this apply to federal student loans or private student loans? So this for sure applies. Both the CARES Act and Secure 2.0 apply to federal student loans. Federal student loans are 92% of all student loans out there. So that is the biggest, almost all of the loans. It's unclear specifically, because it's not law yet, how private student loans are going to be considered as part of Secure 2.0. So we'll still have to kind of wait to see that when that happens. But for sure, for all federal loans, which are 92% of all loans that are out there. I think I got time for 2 more questions. So last 2 here, how long does it take to stand up a program? It really depends. I will tell you that for us and for our programs, partners we work with, we've been able to stand up programs in as little as 4 weeks, and that's all the way from beginning integration to going live. And then we've also worked with partners who have taken a little more time and have taken anywhere between 2 to 3 months. So it really depends on how you want to set up your program and the resources you have available to do this. But this is something that we can work with any of you to move very, very quickly on. And last question, how can we follow up? As we said, we'll be reaching out to all those who enrolled in this webinar. We'll send out an email. Feel free to reach out to us directly there. You can also reach us on spinwheel.com and then also through LinkedIn. So with that, I know we're at the end of time. Covered a lot. Hopefully that was helpful for you and excited to hear from all of you. Thanks. Talk to you soon.